How much will home prices crash in your city, and when will the bottom be? I'm going to answer both of those questions for you guys in this video. But first, we need to talk about what Jerome Powell is doing right now to the US economy and the US housing market. He is in the middle of a shock and awe campaign in terms of pushing interest rates up, increasing expectations for future interest rate hikes, and the result is right now the 30-year mortgage rate in America has surged all the way up to 6.7%. And that surge in mortgage rates means that this housing market, which was already in a bubble, is now even more expensive for the typical home buyer, where today in America, if you want to buy a house, your mortgage is going to cost $2,300 a month on average across America. That's more than 2 times what it was just 2 years ago. And the sad reality is Americans don't have the money to afford this. The typical household in America earns $72,000 a year. That's the median household income according to the most recent data from the US Census. So if you compare that median household income to now what the typical mortgage payment is, that means that the debt to income ratio for home buyers in today's market has surged all the way to 37%, which is even higher than it was at the peak of the previous housing bubble in 2006. So quite literally, it's not that Americans don't want to buy a house. They can't afford to buy a house, and they can't even qualify for the loan or the mortgage to buy a house at current prices and mortgage rates, which is why the housing crash has started and is why the housing crash is going to continue and to get worse. But I think a lot of you know all that at this point. It's no secret that the housing market is going down and that the cost to borrow are surging. What I think a lot of you want to know is how much are prices actually going to go down and when is the bottom going to be? And luckily, I developed a tool that will help you predict that for your housing market. And it's based off a metric called price to earnings ratio, where we take the typical home price in a city and divide it by how much the average worker makes. And if we take a look here at Austin, Texas, this is a great example. The price to earnings ratio in Austin today is 9.7, based off a typical home value of $566,000 according to Zillow, and average worker earnings of $58,000 according to the BLS. And now the reason we know that Austin and the other cities I'm going to talk about in this video are in a bubble is because this price to earnings ratio is way above the long run average, which in this case is 5.9. And it would basically take a 38% decline in this price to earnings ratio to bring Austin's housing market back into harmony, which is why I think Austin is due for a big housing crash. Prices are already down in Austin. They will continue to go down until that PE ratio bottoms out. Another really interesting example here is Miami. If we take a look at Miami, we can see that PE is now up to 9.4, well above the long run average of 6.2. So the PE would need to go down by 34% for Miami's housing market to get back into harmony. And I think what's interesting, if you look at what happened in Miami in 2007, you see what played out. The PE peaked, and then it crashed all the way down to 4.1, which was in 2011, where Miami was actually a really good place to buy back in 2010, 2011, because objectively, home prices were cheap relative to how much money people made. Understanding what to look for is so important so you can be ready to pounce, be ready to strike when the time comes. And this PE ratio, it's going to help you do that. And that's because income and wages, that's the limiting factor on the US housing market. Like, prices and mortgage rates and payments can only go up so much until, they pierce how much people can afford, and people simply can't qualify for loans and buy houses anymore. It's simple math. So at some point, either the wages and the income have to catch up to the prices and the mortgage rates, or the prices and the mortgage rates have to go down. And before getting into more cities and PE ratio and my projections for how much PE needs to crash, I want to actually talk about where I think mortgage rates are heading over the next, let's just say 1 to 2 years, because they've gone way up, 6.7%, which I think is putting a lot of people like, no way am I going to buy in this market with 6.7% mortgage rates. But I think what's going to happen, everyone, is mortgage rates are going to go down, because that's what happens generally in a recession, which we're on the doorstep of. We're in right now, depending on who you talk to. I think we're already in the recession, but over the next 1 to 2 years, the economy is going to get even worse. When that happens, the Fed's going to pivot, and then the bond market is going to want to buy bonds, because in a bad economy, people become risk averse and they want to buy bonds, which is going to push rates down. So that combination of factors is going to cause mortgage rates to crash from where they are today. And if we look from 2007 to 2012, during the last crash, something very similar played out, where the mortgage rate was around 6.7 in July 2007, right when home prices started to go down. And over the next 5 years, the mortgage rate went all the way down to 3.3%. And so that's why it was such a good time to buy back in 2012. Because not only were the prices were low, the rates were low. So I think something very similar could play out over the next couple of years. So I wouldn't totally freak out about these mortgage rates. I would, to be honest, largely ignore what the mortgage rates are doing. Because if you said a year ago that the rates would be 6.5 today, people would have told you you're crazy. So I don't think anyone really knows what the rates are going to be a year from now, but my bet is they're going to be lower, significantly lower from what they are today, which will make for a better buying opportunity. But the corollary to that is that the recession is going to be worse. More people are going to be losing their jobs. So while the rates will be lower in a year, and while home prices will be lower, it's going to feel scary to buy. So this is kind of the mentality I kind of want to key you guys in, that it's not going to feel like when the time to buy comes, it's not going to feel like the time to buy. It's going to feel scary. You're going to see like real estate companies go bankrupt and have to liquidate all their homes in certain housing markets. You're going to see the economies in a lot of these big housing markets go down the tube. You're going to see home builders just continuing to deliver this onslaught of homes under construction. It's going to feel like scary. Like even though the prices and the rates go down, you're not going to want to pull the trigger, but that's where using a metric like PE ratio is going to really help. Like if we look at a market like Atlanta, where the PE ratio is trading at 6.9 today, that's way higher than it's ever been. It was peak at 5 in the last housing bubble. When that went down to 3 in Atlanta in 2012, and literally the home value went down to 131,000. It was this period where everyone was saying, don't buy in Atlanta. But if you looked at PE ratio, you would have known that, oh no, this is actually cheap in Atlanta. Now's the time to buy. So when this PE ratio starts crashing in Atlanta over the next year or 2 years, at a certain point when it hits 5 or 4.5, you're going to know, all right, we're in the long run range of affordability in Atlanta. Now's the time to pull the trigger. Another great example, and I know there's a lot of you out there in California who watch my channel, another great example is San Diego. The San Diego PE ratio is 14.4. You can see it started to go down as the prices in San Diego are going down. The PE ratio is going down. I mean, it's getting more affordable, but still at 14x, we're way too high, way above the long run average of 10, which we were at actually during the pandemic, we were at 10 in August 2020. So to get back to 10, we're going to need a 28% crash in PE, and potentially maybe even it could crash by more. But if you look at the last housing bust, the PE ratio, it actually went below the long run average. So that's something that could happen in a housing crash. Like most of my models, everyone are projecting like what I call a return to baseline, a return to normalcy. But in a housing downturn where things get really bad and everyone gets really scared and the economy gets hit really hard, prices could go below baseline. They could go way down to like rock bottom levels. And I think that could occur in certain cities in this housing bust, maybe more than others. Now, there's one other important thing to understand with this PE ratio and for your city is that prices going down is one way that the PE ratio can go down, but another way is through wages increasing. So if the wages increase, that will cause the PE ratio to go down. Because really the thing we're measuring here is the affordability of the housing market, prices relative to wages. And so a good question to ask is, are wages going to increase in America over the next couple of years? Are they going to stay stagnant? Are they going to go down? And I think it depends on who you ask. If you ask someone who really believes that we're going to have significant inflation for the long run, well, we would need wages to go up a lot for inflation in the long run to continue. But if wages don't go up significantly, and I don't think they're going to go up much more over the next couple of years, then that would cause deflationary pressures. Because again, think of inflation and income and wages as two sides of the same coin. If the prices of things go up, well, then people have to make more money to afford them. If people don't make more money to afford them, then the prices have to come down. So they're two sides of the same coin. And my bet is that we're going to see wage stagnation in a lot of cities and housing markets in America as this recession plays out over the next 1 to 2 years. I think we're already starting to see that. The data I'm looking at on wages in certain markets is showing a big slowdown in wage growth, maybe even goes negative in certain cities. And if we just take a look at a map here on this PE predicted crash in a lot of different housing markets, we can see most of America's red. PE ratio is predicting a crash in a lot of these different markets, but we could see it's reddest in Florida, where we're predicting like 35-40% declines in PE ratio. It's red in Texas, where we're seeing 30% across the board. It's red in California, where we're seeing around 30% or 20% across the board up into Washington. And again, this doesn't necessarily mean prices are going down by 30 or 40%. It means that the combination of prices down and wages up is going to bring affordability back into balance. But what I think is interesting here, folks, is again, these areas in blue, we see certain markets are actually within their normal ranges of affordability in today's housing bubble, like in West Virginia, in Baltimore, in Illinois, in Louisiana, and certain places in the deep south. We have a lighter color here, which means we're not going to have as big of a crash. And on that note, I need to address some of the comments that you guys left me after my last video on the top 10 housing markets to buy during the crash. A lot of the comments, I was shocked, were very negative. If you guys haven't seen this video, you should watch it. I have a link to it in the description. And basically, my whole point in this video is that cities that are affordable are going to perform the best during the housing crash and are already having a lot of people move there because of their affordability. And you guys took issue with this. Henry said that this video is terrible. There's rampant political corruption in Harrisburg, a city I picked. The weather in Pittsburgh and Indy is terrible in the dead of winter, and thus these cities are cheap for a reason. Another commenter said moving somewhere because it's affordable is like going to a used car lot and buying the cheapest car. And I think a lot of the comments to that video in the mindset of these cities suck, who would ever move there, are likely from people who make a lot of money and would be very selective and picky with where they move, which is fine. But the reality is the median household in America makes $72,000 a year. Pre-tax, $72,000 a year. The average worker makes $45,000 a year. So for the average American who wants to buy a home, this isn't a question of finding the coolest city with the best air quality and the warmest weather and the nicest smoothie shops. This is about finding a city where you can buy a house for you and your family and not break the bank. And increasingly, there's fewer and fewer cities where you can do that. This list shows the top 50 largest cities in America by the income you need to be able to afford the typical home in those cities. And we see at the top, you need to make $350,000 in the Bay Area to afford a house. You need to make $220,000 in LA. You need to make $160,000 in Austin. You need to make $150,000 in Denver. These numbers are crazy, folks. At today's prices and interest rates, people cannot afford homes in these cities. But let's keep going down this list. Like now today, even in Miami, you need to make $120,000. In Phoenix, you need to make $113,000. In Raleigh, you need to make $112,000. In Dallas, you need to make $110,000. In Vegas, you need to make $107,000, which is insane. And really, there's only about 10 housing markets where the median household in America that makes $72,000 a year can afford a home at today's prices and rates. That would be Cincinnati, Indianapolis, New Orleans, Detroit, St. Louis, Cleveland, Louisville, Memphis, Birmingham, Pittsburgh, Oklahoma City. Now, of course, not everyone wants to move to Tulsa. I understand that. And a lot of you want to understand when your city is going to be the time to buy. When is your city going to be a top 10 housing market to buy? And using this price to earnings ratio tool that I developed at Reventure Consulting, this is going to really help you do that and to understand how much further your market has to go and the timing of that fall. So if you want access to that tool, hit the join button below and become a channel member. There's a link to it on the channel member community board. I'll be updating it each and every month when new data comes out from Zillow and the Bureau of Labor Statistics.